Good evening, everyone. Welcome to our Long Beach State Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thank you so much for taking time out of your busy schedules to join us for tonight's class. We're just a few minutes past the top of the hour. I know we had a lot of interest in tonight's class, so we're going to allow everybody to get settled into class. This workshop is a very interactive session, so our runtime is just under an hour. But as we go through tonight's content, we're going to be answering questions live. If you do have some questions, you can feel free to use the chat function within Zoom, or you can use the Q&A function. We'll get those questions answered for you on air. We'll also spend some time in the latter part of class kind of going through some questions that the audience has. And then logistically, tonight's coursework that we're going to provide to you or present to you will be all sent back out to you via email tomorrow since you signed up for tonight's class. And we're also recording tonight's class. So we'll have this up on our YouTube channel as well. And so you can kind of look back at your notes and check out some of the topics for tonight. We're excited to bring this content to you. This is a class that we put on once a quarter for the Alumni Association, and really excited that you guys get a chance to spend some time with us to learn a little bit more about the path towards home buying. My name is Jason Maida. I'll be your presenter this evening, and I work for an organization called American Pacific Mortgage. We're one of the leading providers of first-time buyer programs in the state as well as across the country. We utilize our educational platform in partnership with various alumni associations like Long Beach State to help educate future first-time buyers on taking that next steps in home ownership. American Pacific Mortgage is a California-based mortgage company. We're actually one of the top 10 lenders in the country. Our team, like I said, specifically focuses on home buyer education. Now, after tonight's class, you're going to learn a little bit more about how to get connected with us. If you'd like to learn a little bit more about how to take the next steps in home ownership, we're going to share with you some of the ways that you can get connected with us to learn a little bit more about how we can help you design a plan for home ownership. All right. Well, here's what our talking points look like for this evening. So we're going to take a look at, what's going on with the housing market. Lots to talk about from that perspective. We're also going to spend some time looking at what interest rates are doing in today's market. Of course, a lot to talk about there as well if you're paying close attention to what's going on in the economy. We also will go through a budgeting exercise tonight. So I want to take a look at what does it look like if I continue to rent today versus what could it look like if I decide to purchase my home. Whenever that timeline looks like for you. We're going to kind of walk through like a what if scenario with that. We also want to talk a little bit about credit. Credit can be one of those things that can, maybe change the timetable for some of our buyers. So we want to kind of educate you on how to optimize your credit score and maybe uncover some opportunities that exist within your current credit score. We're also going to talk a little bit about loan programs, some of the programs and their guidelines as they're kind of set up for home financing resources. We'll talk a little bit about savings for home ownership, some plans around that. We'll also talk a little bit about employment and income for home ownership, and look at first-time homebuyer programs that are available here in the state of California as well as across the country. And then I want to walk you through the home buying process. So after tonight's class, you may say, hey, Jason, I really want to learn a little bit more about how to take those next steps. We're going to walk you through the milestones of home ownership and also take a look at what does it look like to sit down one-on-one on video and do a consultation with you to design your own customized home buying plan. All right. Well, we're excited again for you to join us on this journey this evening. We hope that we bring a lot of great content for you and hopefully have 2 or 3 things to take away as you plan for home ownership. As we think about home ownership, this is probably going to be one of the biggest financial decisions we decide to make. And so obviously when you're and have a busy schedule during the week, to take time out of a Wednesday night to join us, obviously kind of shows us the importance that you have in home ownership. And when you think about home ownership, there's a lot of great benefits that come along with owning a home, like the ability to create better stability in your housing budget. Now, we all know home prices can be a little bit elevated right now, or the overall cost of housing. But when we think about home ownership, when we own a home, we kind of control our budget versus waiting for a landlord to increase rents as I renew my lease maybe every year. Now, a lot of our clients that are purchasing in today's market, while they might be buying at more elevated rates, there will be a time that comes when those clients can refinance their homes at lower rates, which in turn brings down the monthly payment. So, that obviously changes the cash flow of a potential homeowner in the future through refinancing. And this is an asset that should grow over time. So as that home value goes up, comparing that to what I owe on my house, that creates home equity. For most of us across the country, that's probably our number one asset that we have. And this asset has the ability to be passed along to heirs of an estate, family. And when we look at home ownership, there's some really great tax benefits that come along with owning a home. Potential tax deductibility of interest. And if I decide to make energy improvements to my home, those can also be potentially tax deductible. So what I would encourage our audience tonight, when we think about homeownership and budgeting, especially for homeownership, we want to factor all those great benefits that come into owning a home. Now, as we kind of set up tonight's class, our first kind of launch point for our discussion is to take a look at what a home buying budget might look like for you. So we're going to jump into a calculator that is brought to us by Freddie Mac. And Freddie Mac essentially is one of the larger owners of conventional mortgage products in the country. They provide tools like this to help kind of educate home buyers on this journey towards home ownership. So I am going to share all this presentation material with you tomorrow, but I want to walk you through this example on this calculator. We find that to be really helpful as we kind of frame up the benefits of home ownership for our audience. So let's walk through an example. And for time purposes, we went ahead and kind of pre-filled this calculator out. I would encourage you, when you have some time, jump into this calculator. I think it'll be a super eye-opening experience for you as you're kind of planning towards home ownership. So we, in this example, have a buyer that has about a $3,000 budget on a monthly basis for their rent. This is someone that's paying $15 in renter's insurance, and then expecting that annual rent to go up about 3% each year, right? Now, so that would be in the rental side of things. And then from a home purchase perspective, we're going to project out buying, let's say, a $750,000 home. You're going to learn a little bit about the minimum down payments as part of our underwriting guidelines segment. But ultimately, when we do a conventional loan, the minimum down payment is 3% for a first-time buyer. So you can see that noted here. We have estimated property taxes. Now, we usually calculate property taxes for qualifying at 1.25% of the purchase price. But property taxes do vary based upon where I'm going to buy in the country. So if it's a particular community, depending on some of the infrastructure of that community, that tax basis could look a little bit different. But as kind of more of a baseline number, most lenders like ourselves use 1.25% for our property tax calculation. We have estimated homeowners insurance. We have the maintenance cost of my home that goes into my home buying calculation. So we kind of have that all factored in, right? Now, we also want to consider, what does our loan information look like? What type of loan am I going to do? Well, for most first-time buyers, it generally is a 30-year fixed mortgage, meaning my payments are fixed for the next 30 years. We put an average interest rate of 6.75% for our projections. And then when you take out financing, the lender's going to have origination costs for the financing. Now, we have a number baked in here of $2,000. That can vary based upon the lender that you select. Now, one of your added benefits as part of our Long Beach State Alumni Partnership is that we actually discount our origination costs by $750 to make really your financing much more affordable for you. So that gets factored into our Long Beach State Alumni Discount Program. Now, we have discount points here. And discount points are essentially when you as a buyer are electing to pay more funds out of pocket in order to bring down your interest rate. So that's called discount points. Usually one discount point is the equivalent of 1% of my loan amount. And that will generally bring down my interest rate about 0.25%. And then we have other settlement services. Those are things like title, escrow fees, maybe some of the transfer taxes for the county that I'm going to purchase in. Those settlement services or general closing costs is how we would refer to those. Those will vary based upon ultimately what is negotiated with a seller. Now, when we think about savings for homeownership, I would encourage you to think about two kind of key areas of savings. One is there's down payment, which we just learned just a minute ago. It's about 3% of your purchase price at minimum. And then we have closing costs and prepaid items, which can be somewhere in the range of 2 to 3% of your purchase price, but it ultimately will be dependent on what you negotiate with a seller. And then the last section is kind of our other assumptions screen, which looks at whether we think the home is going to appreciate over the next set amount of years. So we put 4%. We have expected years in the home would be 7 years, the cost of selling my house. And then when we compare that to state and federal tax rates, and then finally kind of including in what an estimated savings rate would be. So we put that all into our calculation of renting versus buying. And so when we look at our calculator, we say, well, from a payment perspective, I know I'm spending $3,000 a month in rent. If I do want to proceed with home ownership in today's market, I'm almost going to have to double my outgo. Now, that might not be the same for all of us in today's session, but in higher cost of living areas, if we're in the Southern California market, that we should expect that housing payment is probably going to increase. At the same time, even though we're increasing that outgo or even doubling our expenses, we still have a buying opportunity of about $57,000 over the next 7 years by deciding to own a home versus deciding to rent. And how we get to that number is when we bake in the equity appreciation of my home over the next 7 years, the tax benefits that can potentially come out of home ownership, that's where I can grow to about a $57,000 opportunity. Now, these numbers, of course, will change if I'm spending $1,500 a month in rent and I'm trying to buy a $750,000 home, or vice versa, if I'm paying $4,000 a month in rent and maybe I think I can purchase a $450,000 home in the market that I desire. So I would encourage you, when you have some time after class, maybe dive into this calculator. I think you'll find it to be a really, like I said, eye-opening exercise for you. Because oftentimes when I get a chance to meet with clients, they're thinking simply about that apples to apples comparison. I'm paying $2,500 in rent, so I probably need to pay $2,500 in mortgage, which may not necessarily be the case if we bake into all those extra benefits that come along with owning a home. Potential tax deductibility, potential equity appreciation. Those are all key elements of home ownership. All right, well, let's take a look at the housing market. And I think, there's a lot going on in the housing market right now. Some good things, believe it or not, even in these kind of economic times. We are starting to see some improvement in inventory that's out there. We just got some latest stats this week. Inventory across the country has improved about 33% year over year. LA, for example, has one of the better inventory supply levels across California. There's 3 top areas in California with better supply year over year. That's LA, that's Sacramento, if anyone's joining us from Sacramento, and the San Jose market. All right. Now here's Long Beach is one of the more popular areas. So if you're a Long Beach alum and you're looking to buy right in Long Beach, I do talk to a lot of clients in the local market. It is a popular area. Now we're seeing some interesting things from a price perspective, a little bit of a dip here in prices as reflected in our graph. Now this is looking at the last 3 years of data, but some of this is a bit cyclical. Generally speaking, in the winter months, which would be your October through probably February, you're going to see kind of slower times in the housing market. Generally, spring and summer, where we're at right now, we see busier times. Now, California is kind of the exception, but in most parts of the country, as things warm up, you start to see more activity with sellers listing properties, buyers being more active in the market. So generally speaking, you'll see spring and summer, typically the busier buying seasons. Also, families trying to figure out where they want to maybe have kids attend a certain school district, or maybe someone gets a relocation of a job. All those things kind of happen generally in those spring and summer buying months. But this kind of gives you a quick snapshot of what the housing market looks like. You can see we're still kind of trended upwards over the last 3 years, although we have that slight dip here. I think, as we look at inventory levels across California, for example, we're still challenged with inventory, not necessarily a sufficient amount of supply to support buyer demand. And as we look closer to the interest rate market, which has been a little bit of a wild ride over the last couple of weeks, interest rates will push buyer demand. But the question will be, is with buyer demand potentially elevating at some point, do we have enough supply to support that? Now, some new construction is being built, especially in our Southern California markets, on the outer edges, San Bernardino County, Riverside County. We're seeing a lot of new builder activity, which can help kind of close the gap when it comes to inventory challenges. But we are going to still need to see more sellers come to market in the resale space. Now, on the interest rate side, like I mentioned, last 2 weeks have been a bit of a wild ride. We had interest rates dip to as low as 6.3% 2 Fridays ago. interest rates completely reversed that. Now we're in the high sixes today. All of kind of the uncertainties around what's going on with tariffs. Are we having tariffs? Are we not? Now we have a 90-day pause on tariffs, but there's still, a back and forth a bit with U.S. and China with tariffs escalating. It sounds like they're now in negotiations. The last 3 days of trading has been a bit better in the markets. We've actually seen interest rates rebound the last 3 days, all because tariffs are now kind of on pause. And with the news of U.S. and China potentially negotiating tariffs, the market has rallied a little bit behind that from an interest rate perspective. Now, the Dow Jones, which is measuring, kind of what the stock market is doing, didn't have such a good day. And typically, interest rates will work inversely to what the stock market is doing. So if the stock market has a great day, probably not a great day for interest rates. If the stock market has a pretty poor day, then you'll see interest rates usually improve on that side. Now, let's look at the last 12 months of data on interest rates. So you can see as we looked back to last April, interest rates were at a much higher level last year. So we're certainly below that 7% mark, which is kind of at a more of a kind of a psychological level too for some buyers. Once we get under 7, it can spur a little bit of more buyer activity out there. We really were kind of hopeful that we're going to push into the low 6s as we kind of saw 2 Fridays ago, but now we've kind of elevated right back up. We're going to see a little bit of this kind of choppy market for the rest of 2025 as we kind of see things going on in the economic markets. Now, we are still at elevated levels as we look at it from a historical perspective. Average interest rate, if we look back at the last 20 years, probably somewhere around the 5.5% range. And we will see interest rates trend down, but how we're here today from an interest rate perspective is really kind of where we're at from an economics perspective. The Federal Reserve has ratcheted up interest rates to combat inflation. We all kind of feel it today when we go to the grocery store. It's a little bit more expensive, or maybe not a little bit more. It's a lot more expensive. Cost of fuel more expensive. So inflation has risen, right? So in order to combat inflation, Federal Reserve has ratcheted up the federal funds rate to bring that down. The inflation goal is 2% by the Federal Reserve. They're also looking at employment numbers, what's going on with, unemployment rates, what's going on with new job creation. Those are all important things. The Federal Reserve is looking at 2 rate cuts this year, which will have a spillover effect into mortgage interest rates. And I do think as we kind of figure out this kind of uncertainty that we have today in the markets, we will hopefully see interest rates trend lower this year. Not a significant amount, but my sense is, we're probably going to stay in the mid 6s or slightly higher throughout the duration of 25. But if you look at the last 20 years, even going back 20 years from now, it was very similar rates. You can see these gray bars represent major economic events. So this one is the housing crisis of 2008, 2009, and then you can see the pandemic here. The question we get often is, when are we going to get back to 2.5% rates? Well, that's probably not going to happen. Let's hope that doesn't ever happen, because obviously something catastrophic has happened globally. But I think when we look at historical averages, we're probably somewhere around that 5.5% range. Now, interest rates are not the same for all clients, so I think that's really important to understand. There's various characteristics that go into an interest rate, things like your credit score and your overall eligibility, the type of loan program that you're going to select, how much am I trying to finance? Ultimately, like, what's my down payment look like? Am I going to, like we talked a little bit earlier about buying points to bring down my interest rate? Do I decide to do that? That can obviously lower the cost of your interest rate or the interest rate offering, but it will increase the cost. As a side note, the break-even point usually when we decide to buy points, so meaning how long is it going to take for me to recoup my investment, is usually about 3 to 4 years. And we don't really encourage buying points in today's market because many of our clients are going to turn around and refinance in a couple years. So they just can't get a good break-even on investments like that. And then the loan term can also influence your interest rate. So generally speaking, the shorter my term is of my loan, the lower my interest rate is going to be. Now, as we meet with our clients across the country to design their home buying plans, we're going to figure out what the right product matches for you, what the right term is, and we're going to educate you on what your options look like. But ultimately, that can help give you an idea of at least what goes into interest rates. Now, credit plays a major role in mortgage interest rates, the product, as well as mortgage insurance that you're going to learn a little bit more about in tonight's class. Every product has a minimum credit score, and we kind of spotlighted a few of the products here that you can see on screen. So those are generally the minimum credit score requirements for each one of those products. Now, when we look at the overall credit report, major events like bankruptcies, short sales, foreclosures, collections, those will have a bigger impact in our credit score. We're going to dive a little bit deeper into a matrix to show you how long they'll stay with your credit, but ultimately those are kind of be your bigger ticket items that will obviously negatively impact your score. Credit utilization is looking at revolving accounts versus your credit limits. We're going to walk you through kind of a quick tip on how to manage utilization, but that's one of more of our kind of our low-hanging opportunities for most clients is to help reduce credit card debt in order to elevate their credit scores. And then account closure, we'll spend some time looking at that as we analyze a credit modeling system. And in lending, we look at all three credit scores. Now, there's three different agencies that I'm sure you're all aware of. There's Equifax, there's Experian, and then there's TransUnion. In lending, we look at the middle score that's offered by each one of those agencies. So if I'm at a 760 is my highest score, let's say 740 is my middle score, and then 720 is my lowest score, 740 would be the score that would be used to qualify me for my financing. Now, if I have a partner that's going to join me in the qualifying, and let's say my partner's at 700, 680, and then 660. Well, 680 is the minimum, or sorry, the lowest middle score between the two of us. So in that case, if my partner's going to apply with me, then that 680 score would be what we use for qualifying purposes. Now, I mentioned to you a matrix that you can kind of reference. If you've had any past challenges on your credit, this is a matrix that shows you how long they'll be on your credit report. Now, just about an hour ago, I was meeting with a client in the San Bernardino market. They had some past student loan challenges that were over 90-day plus delinquent. Well, those student loans are actually going to come off that client's credit report in 7 years. And actually, when we look closer at their credit report, we can actually model their credit to project out what the score is going to be. When those student loans came off their credit report, they actually elevated their credit score by like 50 points. So if you had any past challenges on your credit report, this will give you a sense of how long they'll stay with you. Now, the immediate impact to your credit score is in the most recent 12 to 24 months from the event. So if I had a late payment on my student loans back in, let's say, October of 23, I'm still inside of 2 years, so it's probably still impacting my credit score. But as I get further and further away from the event, the higher my credit score will kind of organically go. This is a kind of a weighting, if you will, for the FICO score calculation. So we found this to be pretty helpful in educating our clients about credit. Now, the good thing, there's a lot of great resources out there in credit, and most of our clients have visibility to their credit scores. So when I get a chance to meet with clients for their consultations, most clients kind of have a general idea of where they're at. Now, there are 3 different models to scoring. The credit card score model is what's used for monitoring services, but when you apply for auto financing, there's an auto model. And then of course, when you apply for mortgage, there's a mortgage model. So it might look a little bit different in the score that we use versus maybe what you've achieved or looked at in maybe your Credit Karma monitoring tools. So let's kind of walk through the weighting here. So 15% is going to be how long have I had credit? So the more mature my credit file is, the better my credit score is probably going to be. So if I compare a client that has a 2-year credit history versus someone that has a 10-year history with identical payment history, the 10-year history is probably going to be a higher credit score. 20% is going to be how much new credit am I trying to get access to? So am I opening new accounts? Do I have hard inquiries on my credit that are impacting my score, especially in the most recent 12 to 24 months? So we want to be really careful with that. Now, in our process, we always start with a soft credit check. So after tonight's class, maybe you're interested in getting pre-approved for home financing. We only start with a soft credit check. And the reason why we do that is because many of our first-time buyers are looking to buy maybe in the next several months or maybe the next few years down the road. So we don't want to necessarily impact your credit score. And so we always start with a soft credit check, which does not have any impact to the score at all. The next component is how much do I owe? I kind of touched on this just briefly, which is credit utilization. What my credit balances look like versus what my credit limits are. So simply put, if I have $10,000 in limits, my balances are $5,000. Right now, I'm at 50% utilization of credit. If we were to kind of look at different tier levels, if you will, once I go above 50% utilization of credit, probably have some pullback in my credit score. Once I can pay that debt below 50%, now the score starts to go back up. If I can pay it down a little bit more to 30% or $3,000, better score. 10% or below would be optimal to get my score to the highest levels. Now, the highest credit score you can have is 850. So, if you're trying to really perfect your credit score, we would ideally want to get that credit utilization below 10%. Now, let me give you a quick tip on how to manage utilization. If you took a look at one of your credit card statements, there's 2 dates on those statements. One is the billing statement date or cycle date. The other is your due date. So that's when the payment's due. The billing cycle date's actually when the credit card issuer closes out all your activity, all your debits and credits on your credit card, and then sends out your account information to the credit agencies. So my tip here for you tonight is if you're really trying to maximize credit score, try to pay down your balances before the end of the credit or the billing cycle date. Because when you do that, you have a much lower balance that ultimately gets reported out to the agencies and in turn shows a better credit score when it comes to maybe qualifying for your mortgage or any other type of credit product you're looking at. All right. And then the last component is payment history. That's simply put, how am I paying on my bills, right? So if I had late payments, generally going to impact me in the most 12 to 24 months, but it will stay on my credit report for 7 years. The more severe my late payment is, bigger impact I'm going to have to my credit score. When I work with clients in building their plans, the biggest area of opportunity generally is going to be amount owed. Okay. So if we can kind of strategically look at debt that maybe you could potentially pay down to lessen up payments and improve cash flow and or improve your credit score, then that's going to create the best opportunity for our first-time buyers. All right, one of the things that comes up on credit reports will be student loans. If you do have federal student loans right now, they're probably in pause right now because of pending litigation on student loan forgiveness. Those will be categorized as in forbearance. Now, whether I'm in forbearance or I'm in deferment, as a lending side of things, we do have to count a minimum payment when it comes to qualifying. So the rule is if I'm applying for a conventional loan, which we're going to talk about in just a few minutes, a conventional loan requires us to apply a 1% payment to the aggregate balances on outstanding student loans. If I'm applying for an FHA loan, I take 0.5% of the outstanding balances and I use that as my payment. Now, there are still active income-based repayment programs out there. We have clients that are enrolled in those. Sometimes, unless you initiate the payment, then the income-based repayment program is not active. So if you're looking to apply soon for a mortgage, and I think there's going to be some ruling on student loans in September or October, but if you're looking to purchase before then, we want to kind of talk through student loans and how that might impact you. But if we had a client that was at $75,000 in student loan debt and they did have an active repayment of say $250 on an income-based, we can still use that for qualifying. It's just some clients might be in forbearance or deferment. Even though you're not actively paying on those loans, we still have to count a minimum payment when it comes to qualifying. All right, I know we had some join late for class, and I wanted to mention to the group, if you do have questions, you can use the chat or the Q&A function. I'll, of course, get those questions answered online for you. Any questions from our audience so far before we talk a little bit about loan programs? Okay. All right, I don't see anybody typing away yet. So of course, I'll be monitoring the chat and the Q&A, and I'll answer those as we get them. So let's talk a little bit about loan programs. There's a wide variety of different programs that are offered by lenders across the country. This is a spotlight of 5 of those programs that we kind of key in on. We're going to do a little bit more of a deeper dive into conventional and FHA loans in just a bit. But I'm going to give you kind of a high level look at each one of these loan products. And the first one is a conventional loan. You've probably heard about that. Conventional loans are under Fannie Mae and Freddie Mac guidelines. We looked at the Freddie Mac calculator as we launched in today's class. For first-time buyers, the minimum down payment is 3% down to a credit score of 620 with a maximum loan amount that actually stretches all the way up to 1.209 million. Now, there is what we call as a conforming loan limit, which is 802. So basically the 3% down payment threshold goes up to 802. And then if we have to finance more than 802,000, then that down payment elevates from 3% to 5%. Now, if you're joining us in one of our California markets, it may be considered a high cost of living area, and that high cost of living designation allows us to go up to that higher loan amount. The conventional product occupies about 60 to 70% of all originations across the country. So it's a pretty popular product. there is a bit of a misconception out there that first-time buyers have to put 20% down on a conventional loan, which is definitely not the case. So you can put as little as 3% down. Oftentimes I hear clients saying that, because they're putting less than 20% down, they have to do FHA, which is our next product in our lineup. But if you qualify for conventional, you can still put as little as 3% down. The FHA loan is a government insured loan, has a minimum down payment of 3.5%, minimum credit score of 580, very similar to the conventional loan that as I work in high cost of living areas, it has higher loan amounts, but ultimately FHA sets the minimum loan amount, maximum loan amount by county. So if I'm going to buy in Kern County, for example, out in Bakersfield, that loan amount is going to be lower than maybe if I go over the hill and I'm in LA County, right? Now with FHA loan, it is a government insured loan, and you're going to learn a little bit more about mortgage insurance in just a bit. Now, we are seeing some changes starting to come through with some of the products and the new administration on this particular product with both FHA and USDA that you can see here. The guidelines no longer allow non-residents to access these programs. So that has been a change that I think is going to go in effect in May, it looks like. Not something that obviously we're excited about at all. But ultimately, those are changes with both the FHA and USDA product. If you are a DACA recipient, the conventional loan still allows that. So I know there's been a lot of misconception around that, but if you're a DACA recipient, you still can qualify under a Fannie Mae and Freddie Mac product. We'll spend some more time answering questions on that if you do have any. The jumbo loan has a minimum down payment of 10 to 15%. Now, the jumbo loan product ultimately is for clients that need to buy a little bit higher than what maybe a Fannie Mae or Freddie Mac loan can support. It does have higher credit score thresholds, 700 plus, but it will give clients access to more funding if they're buying at higher purchase prices. And then our VA home loan is for our veterans that have eligibility under the VA product. It's a 0 down payment option, minimum credit score of 620. There is really no maximum loan amount on the VA product. And it is for veterans. And now if you are partially disabled and receiving any type of VA benefits, there's a thing called a VA funding fee that ultimately you're exempt from. And so as a first-time user as a VA, if you're not exempt from a funding fee, that cost for the VA product is usually 2.3% of your loan amount that gets financed in for you. And then I talked a little bit about the residency status changes with USDA, but let me give you a little bit more of kind of context around USDA. USDA is a product designed to help support buyers that need to purchase in rural areas. It does have a 0 down payment option. The loan amounts will vary very similar to the FHA loan based upon county. There are 2 requirements to USDA. We're going to look at the household income and size, but we're also going to look at the location of the property. So to use that product, you're going to have to purchase in a USDA eligible area. All right, we get a lot of questions that come in around mortgage insurance. What is it? How does it work? And so we want to do a PMI explained section for you. There's 2 kind of channels, if you will, around mortgage insurance. There's the conventional mortgage insurance, which is supported by private mortgage insurance. So there's about 7 to 8 different private mortgage insurance companies that essentially insure lenders against default by the buyer. So if a buyer had a challenge, was unable to make payments, the private mortgage insurance would step in and create protection for the conventional, for the lending company. Now it is always, for the most part, buyer paid. On PMI, it is calculated based upon your down payment, your credit score, and then how much you finance. Now, if you've already started doing your home search on Zillow or Redfin, there's some calculators obviously on those sites. What I've found in working with clients, those PMI calculators don't really have an accurate example. So we're going to walk you through what a real-time one looks like, but ultimately down payment, credit score, and how much you finance influence the cost of mortgage insurance. Now on conventional mortgage insurance specifically, it's not for the life alone. Generally, once I have it for 2 years and I've accrued at least 22% equity, so the combination of those 2 items, then I can apply to have my mortgage insurance canceled. If we look at that example of mortgage insurance about, let's say, financing $600,000, I had a 740 credit score and I was at a 3% down payment, my mortgage insurance is probably about $185 a month. Now, the higher I can bring my credit score, the more money I can put down, the lesser the burden would be of my mortgage insurance. Now, on the FHA side of things, that is a government insured product. It looks a little bit different. So there's 2 forms of mortgage insurance for FHA. Now, it is insured by the U.S. government, so it's a little bit different. It's not privately insured. So FHA has two components. It has monthly mortgage insurance, which is 0.55% of the total loan amount. Then we divide that by 12 when we come up with a monthly dollar figure. And then there's also upfront mortgage insurance, which is 1.75% of my loan amount. Now, with this mortgage insurance, it does not have a cancellation option like you have with the conventional product. So once I reach the 20% threshold, I really can't exit the mortgage insurance. So I would have to probably look at refinancing if I was to get rid of my FHA mortgage insurance and probably transition to more of a conventional loan. The FHA loan for most clients, we're going to use that as an entry point to homeownership because it does have a lot more flexibility and leniency with guidelines. And maybe a client's currently at a 620 credit score and they really want to purchase. FHA is going to allow us to get that entry point to homeownership. But as we improve that score over time and they're owning their home and they go from 620 to 716 credit score, as that home appreciates, then we'd probably look to transition over to a conventional loan. So with an FHA scenario with mortgage insurance, we take that same $600,000 loan. We have upfront mortgage insurance that would get kind of stacked into the amount financed of $10,500, and then we have monthly mortgage insurance at $275. All right. So that's kind of the difference as you look at the different expense structures between both the conventional loan and the FHA loan. All right, let's spend some time talking a little bit about employment and overall income and qualifying for your mortgage. Now, I want to also include for you in tonight's class, if you're thinking about taking the next steps in homeownership, I wanted to provide you some of the typical documents that we'll request from you so you can kind of get a head start on that stuff. And I want to kind of spend some time also talking about employment. Now, in lending, we always look at the last 2 years of employment history, but that also does include education. And so as I teach classes like this, especially for our alumni associations, we have some clients that have just recently graduated. So let's say, for example, I graduated in the fall and I just started my new job on January 1. Even though I'm very new to my job, I can still use that future income because I can show 2 years of education and or employment history to qualify for my financing. So there's a 2-year rule out there, but we have to exhibit work history and or educational background for the last 2 years. Now, if I have dual employment, so let's say I'm working for 2 different medical facilities, in that case, from a 2-year perspective, I do have to show that I've been working for both jobs simultaneously for 2 years because we have to show sustainability with taking on 2 jobs. Now, if I'm self-employed, I have to show 2 years of consistent tax filings in order to be able to use my income for self-employment. If I'm working a full-time job, and let's say I also work for Uber or Lyft, and I'm an independent contractor on the weekends, if I do want to introduce that independent contractor income, then I have to show that I've been working my 40-hour workweek job and my self-employment income or independent contractor income simultaneously for the last 2 years. All right. So those are some of the scenarios that come up for some of our clients. Now, the last thing I will leave you with here around income is that if you have additional sources of income, like let's say you have your partner that's contributing to the household expenses, but they're choosing not to be on the loan for whatever reason, I can't use that income provided unless they decide they want to be as part of the financing. Also, sometimes what comes up is we have a client that wants to qualify for a mortgage. They're currently obtaining room rents, right, for their current place, and they want to use that into their qualifying calculation. Unfortunately, we can't use that because generally those room rents will not carry forward into the new property. Now, some of you in tonight's class may be considering purchasing an investment property, which does require a minimum down payment of 5%. In some scenarios, investment property purchases will allow us to use projected rents in order to help you qualify for a mortgage. So some of our class is kind of a little bit more interested in investment property or multifamily scenarios of purchasing. We can certainly tackle some questions on that tonight as well. All right, kind of staying with the theme of employment and income, I wanted to walk you through an expense versus income analysis that every lender does to determine eligibility for a buyer. And it's a really simple calculation that looks at your projected housing expense along with your existing debts that you have. So if you look at your mortgage, you have your principal and interest of your loan, you have some estimated property taxes for the house, homeowners insurance, and then if I'm paying mortgage insurance because I'm putting less than 20% down, and maybe I'm buying a townhouse, all that gets bundled into the housing expense. And let's say from a general expense perspective, I have a few credit cards that I pay on, my auto expense, and maybe a student loan, right? So those are all my expenses. Then we compare that versus your income. So we have a scenario for a client here that has a $2,500 mortgage payment, $500 in debt, and they make $8,500 a month. So in evaluating what we call the debt to income ratio, that client is currently at 35.3% in debt to income ratio. All right. Now, when we evaluate maximum qualifying, the maximum we'd want to see that percentage would be 45 to as high as 50%. If you were kind of targeting what would be kind of considered excellent or maybe optimal, for most clients that I work with, that optimal level is probably 33 to 36%. So we're looking at expenses not to exceed 33 to 36% of the pre-tax or gross monthly income for a borrower. Now, beyond this metric that we evaluate for qualifying, affordability is really super important. So those are conversations that we're going to have in a consultation with you to figure out, how does the $2,500 mortgage payment feel, right? Is that going to feel affordable for you? Do you have to make some concessions on other expenses? We want to make sure that we create an affordable home buying plan, but also make sure that plan is sustainable over time. So the last ingredient that really goes into a home buying plan is down payment, and that's the savings for home ownership. You know, when I think about home ownership, there's usually probably two challenges to getting into home ownership sooner than later. It could be around credit, because we got to maybe pay down debt, or maybe we have some student loans that are coming back into repayment, so we're kind of worried about that. Or it could be savings for home ownership. And so we're going to talk really quickly about what we typically validate for the assets that are going to be used for home buying. But then I want to walk you through a savings plan for home ownership, and then kind of dovetail that into assistance programs that are available for you as well. So this is, you can see on screen some of the acceptable sources of down payment. Obviously, if you have money saved in checking or savings accounts or money markets, those can totally be used. Even brokerage accounts can be used, 401ks, 403bs. I would recommend, if you're getting into investment or retirement assets, definitely talk to your tax or financial advisor to make sure that's going to work for you. Now, gift funds can be potentially used, and that's where a family member is contributing to your household or your housing expense, so they can gift you funds right away. Now, most assets have to be seasoned at least 60 days, but gift funds can be transferred over immediately. There is a process for that, which we've kind of outlined for you on screen. But I want to spend some time talking about a savings plan, because as I get a chance to meet with clients across the country and develop plans for them for home ownership, savings can be kind of a gap in the plan. And so the plan that we've kind of instituted for our classes to provide some encouragement around savings is, it looks like this. So if I'm currently, let's say, spending $2,000 a month in rent, and I lack maybe the savings right now, but I know based upon my new job that I just started, I can afford a $3,500 monthly expense for housing. Here's what I would encourage that client to do. On the first of the month, when I'm paying my rental payment, I'm transferring that $2,000 to my landlord. Start creating the habit or discipline that I'm now taking that additional $1,500 that I know I can afford from a budget perspective and transfer that to my savings account, right? And obviously, we know it's saving money over time. And so over 6 months, we got $9,000 saved. Over 12 months, we have $18,000 saved. But it also creates that rhythm and discipline of now being at that $3,500 expense, because now we're not going to have to worry about making that huge leap up when it comes to getting the keys to our house and the time to make that monthly payment. And of course, we're saving money over time. And believe it or not, having $9,000 to $18,000 in savings, that can make homeownership certainly a reality for you. Now, there are assistance programs available in all parts of the country. We're going to kind of look closer at California, because I think most of us are in California for tonight's class. We partner with an organization called CalHFA, which is the California Housing Finance Agency, designed to support low to moderate income households with resources to obtain homeownership. We're proud to be the #1 provider of these products all across the state. So whether you're in San Diego, Orange County, LA, Sacramento, San Jose, wherever it might be, we provide the most number of resources for these programs. And we're really passionate about supporting our communities with these tools. So I'm going to just give you kind of high level look at some of these tools here. And certainly if you decide to take the next step in homeownership after tonight's class, we'd love to be able to kind of customize some of these options for you. The first program is called MyHome Assistance, which essentially provides the minimum down payment requirement for a conventional or an FHA loan. So it's 3% for a conventional loan, 3.5% for an FHA loan. Essentially what this is, it's a low interest rate loan that the state's providing for you at a 1% simple interest rate loan. And the nice thing about that assistance is you don't pay it back until you either sell your home or if you decide to refinance in the future. Okay, so that can really close the gap, cover some resources for down payment. And then another product that we just rolled out 3 weeks ago with CalHFA is called My Access, which can layer on to the My Home product. It's the equivalent of 2.5% of my loan amount. It's also a 1% simple interest rate loan, does not get paid back until you sell or refinance the home in the future. Now, the My Access program was introduced because we've had the ZIP program for several years, but the ZIP program would really elevate the first mortgage rate for a home buyer. So My Access provides a much better rate, if you will, to the first mortgage when we layer on both the My Home and the My Access product. So those are in the CalHFA suite of products. You may have heard or kind of coordinated or connected CalHFA to the Dream for All program. There's a lot of kind of misinformation out there on the Dream for All. The Dream for All is currently, we're funding out clients that won the lottery last year in 2024. We're still working through the allocations of funds from the general state fund for that program. There right now is no plans for a Dream for All in 2025. So I know there's some misinformation online out there. That program does not re-up every April. It all is based upon state's general budget. And currently we don't have a second funding source for that. Now, we do have a national program for APM. It's called the Pathway Program. So if you're looking to purchase in other parts of the country, the Pathway DPA program provides anywhere between 3.5% to 5% of your loan amount in assistance funds. There's also other programs like the GSFA program. You might have heard about that. That's the Golden State Finance Authority program. For me and working with clients, we generally rely on GSFA when clients don't qualify for CalHFA because CalHFA tends to be a cheaper funding source, both from an interest rate perspective as well as some of the assistance repayment options. Let me just give you a quick scenario on what it would look like if you chose to select, say, a CalHFA assistance product for your home buying resources. So if I bought, let's say, a $450,000 home traditionally, right? So if I saved up for my down payment, my closing costs, which, as we heard earlier, estimates about 2 to 3% of my purchase price, I probably need about $22,000 to $27,000 out of pocket. But when I now look down here at the CalHFA scenario, I could get my Home Assistance program to cover my down payment. So if I just wanted to use that product, maybe I'm only putting $9,000 to $13,000 out of pocket. If I still needed additional resources, I could tap into the My Access product, and maybe now I'm putting $3,000 to $4,000 out of pocket. So there are plenty of resources out there for you as first-time buyers, and these programs are all across the state. Now, there are income limits for these programs. It's 150% of the median income. I'll share with you the income limits in just a bit, and of course, you'll have this presentation material. The minimum credit score for the FHA version of this product is 640, 680 for a conventional loan. We have a debt to income ratio requirement or maximum, which you learned about earlier this evening. Now, a first-time buyer is someone that hasn't owned a home in the last 3 years. So if you have a rental property in New York right now and you've been living in LA for the last 4 years as a renter, you're still considered a first-time buyer. This is a product that's only eligible for one-unit properties, which would include single-family homes, new construction, townhomes, condos, even manufactured homes, but you have to own the land to use a manufactured home product. Here's the income limits for our Southern California markets. Now, I know I might have some of you that are joining us from other parts of California. We'll put in the chat the link to the CalHFA income limit, so we'll get that out there. So if you're not in one of these counties or looking to purchase in one of these counties, we will get that in the chat for you. These income limits update every June, so we'll probably get a higher income limit just based upon overall cost of living. But ultimately, they're based upon 150% of the AMI or median income in your respective markets. All right, so that's the CalHFA Assistance Program, a wonderful tool to really make home buying that much more of a near-term goal for you. Now, we're rounding the finish line here, and before we wrap up tonight's class, I do want to walk you through the home buying process because I think this is a really important element of understanding where do we go from here after tonight's class. We've created this visual tool, which is our 6 steps of home buying, to kind of show you what those milestones look like. Now, after tonight's class, you may want to learn a little bit more about what home buying and customizing a plan looks like for you. I meet with all of our clients through our partnerships for a 30-minute no obligation really consultation, and it's free for you to understand your options. And we meet with clients that are in all different time frames of buying, whether I want to buy this weekend or I want to buy 3 years from now. At least we can help provide you all the tools and resources for home buying. Now, once we decide on where your financing is at, we're going to issue you a pre-approval, which ultimately says that you're eligible to now go out and start looking for homes and making offers on homes. A pre-approval letter is generally good for 60 days, but we can always recertify your pre-approval at any time. So we have clients that are looking to purchase end of this year. They'll still get pre-approved today, but at least the pre-approval shows them their baseline qualifying numbers and allows them to start knowing kind of where should they be looking at from a sales price perspective and ultimately kind of an overall budget standpoint. Now, step 2 brings us to the house hunting phase. We would encourage you to get connected with a local realtor. We have preferred realtors that we work with all across our markets that we support. But ultimately, a trusted realtor is going to be hopefully an expert in their market, understand proper negotiations in the contract and timelines involved in a real estate transaction, and hopefully help negotiate the best possible option for you. Most of your searching will start online, then it will move probably to in-person, and then you'll start kind of probably having a target community or a target home that you're looking at. Now, as you're going through the home search, we're going to be working with you because you may have different scenarios you want us to run for you. Once you lock in on a place that you really love and you submit an offer to that seller, it may not get accepted the first time. It may take 2 or 3 times to get that accepted offer. But once you have an accepted offer with the seller, now you move to step 3. Now you're what we call in escrow to purchase your home. Now, that contract that you've agreed to will have timelines that you have to adhere to as a buyer. But ultimately, traditional timelines are from step 3, which is opening escrow, to when you get your keys to your house. It's about a 30-day process. Now, it can be as short as 14 days. In fact, we offer what we call a quick close program, which allows you to shorten that to 14 days to have the most competitive offer. But certainly, the traditional time frame is usually 30 days. Now, within 24 hours of your accepted offer, you're going to get a call from me saying, hey, congratulations. That's a huge step. You got your offer accepted. Talk a little bit about action items for you, and then schedule you for a follow-up video session. So what we do with every client once they're under contract is we meet with them again to kind of reaffirm all the financing details and let them know what to expect. Because when you purchase a home, there's a lot of stuff coming at you. And so we want to make sure you understand how to disseminate what information and really understand kind of where you're going from here. Now, within a couple of days of the accepted offer, you will have one of your action items being to make an earnest money deposit. That deposit is a good faith deposit that goes into the transaction. It's usually 1 to 2% of your purchase price. That money gets held with an escrow company and ultimately gets applied to your total out-of-pocket expense, the down payment, the closing costs, and prepaid items for your home. Now, within a real estate contract, specifically in California, there are contingency periods that basically allow you as a buyer to do some homework on the property, which would include getting your house appraised to make sure the home is worth what you're buying it for, getting some inspections done, whether that's a roof inspection, home inspection, maybe it's to get the foundation checked out, whatever you may need to do to make sure you feel comfortable with the purchase. Then, of course, as the lending side of things, making sure that we'll get your loan approved. The typical timelines for contingencies is usually 14 to 17 days from day 1 of your accepted offer. So you have that time period to go in and do your investigative work. Now, behind the scenes, while you're doing those things, we're working on the administrative side of the financing, processing the loan, working on locking in the interest rate. Interest rates change daily, which is really important to understand. So once you go under contract with the seller, we're going to strategically watch the market for you and kind of let you know when we think there's a good time to lock in the interest rate. You heard me talk about interest rates in our interest rate segment. 2 weeks ago, we were able to lock clients at the lowest levels we've seen in 2025, even though, they maybe just went under contract to purchase their home or have been in contract for a while, because we want to make sure that we can kind of study the markets and make sure that we can tap into the best opportunity for our clients. Now, once we lock in an interest rate, that rate stays with the loan throughout the duration of the processing. We process in the loan things like verifying your employment, your assets, making sure your product is set up properly. Speaking of product, I had one of our questions came in the chat, which was, what are the benefits of putting down 20%? Well, one of the big benefits of putting down 20% is you have no mortgage insurance. So that gets rid of that. But also potentially the interest rate option can be lower when you put that a level of down payment. Step 5 is going to be your loan approval. That's where an underwriter has reviewed all your documents, validated the program structure, everything looks good, and signs off with an underwriting approval. Our team, once we get that approval, may reach out for some follow-up items. But ultimately, with that loan approval, we've also received probably appraisal back on the house, and everything checks out fine. That is now moving us to almost 3/4 of the way through the process. Now, as we move through these various milestones that you've seen, you're going to be getting disclosures from our team that highlights all of your kind of agreed upon financing options. And at the very end, or 3 days, I should say, prior to the very end, you're going to be receiving a final closing disclosure that gives you a 3-day cooling off period before you get to the final stages. Now, I just want to kind of quickly jump back to that contingency period. Your contingency period is going to be up right around step 5, okay? And prior to moving to the final stages, you as a buyer have the opportunity to sign off on that contingency after you feel comfortable with all of the work that's been done in terms of inspections that have been done on the property, okay? So until you sign off on that contingency, your deposit is completely protected into the transaction. So as we kind of go to the finish line here in buying a home, that's the closing of the loan phase. Now, that is one of the in-person elements of purchasing a home. You do have to still meet in person with the public notary. You're signing documents in person and then completing a final wire transfer of your closing costs, your down payment funds. If you elect to, use a first-time buyer program, we're going to be funding that on your behalf in addition to the first mortgage that's provided. So all those funds get kind of reconciled by an escrow team here in California. After that is completed, sellers receiving their proceeds that they expect, and then you're contributing what you're supposed to as a buyer. Then documents get recorded with the county recorder's office. They record a grant deed that transfers the ownership from the seller to you, as well as the deed for the property. Okay, or for the loan, I'm sorry. And after that happens, then now you're confirmed as the new owner of the property. And that's a huge day of celebration. I get a chance at least once or twice a day to make these calls to say congratulations. I made one earlier today for one of our clients in Orange County that purchased their new home. And it's a big day of celebration because, that is a huge accomplishment to probably really achieve one of the number one financial goals for most people across the country. It's a big deal. So we want to celebrate with you. And our relationship doesn't end there, though. We want to make sure that we're always connected with our clients. So, part of our aftercare, even though you're busy with your lives owning a home, we still want to stay connected with you. So as opportunities arrive for refinancing or just understanding some changes financially for you, maybe your family's grown and you want to buy another house, we're going to be here to help educate you on what new opportunities look like. So we're always checking with our clients on an annual basis. All right. So, we look at this as a long-term relationship, not just a transaction. Obviously, our relationship with our clients start with our educational classes, goes to consultation, then it goes to buying a house, and then we want to obviously follow the progress of your financial lives and how we can best support you. Well, if you're thinking about moving forward in the process, I love to be able to get connected with you for a one-on-one meeting to design your own customized, no obligation, free home buying plan. It starts with a really simple 3-step process, completing an online application. We do a soft credit check, and then we will meet with you on video, and you'll be able to schedule using our scheduling system to schedule a time that works great for you. Again, that's a 30-minute session that I do with all of our clients to help design a home buying option and make sure that you have all the tools and resources you need to make a really great financial decision. Now, after tonight's class, you may just have some general questions that you want to kind of talk to us one-on-one about. Maybe it's credit related or savings plan related. We would encourage you to schedule an introductory call. We'd love to be able to meet with you on the phone just to answer any of those questions that you have. This is kind of what a consultation service looks like. We want to know, where do we want to purchase? What's our budget look like? Can we help you from a credit perspective? Are some of the assistance programs we reviewed tonight, are they applicable for you? Would they really help benefit you? We're going to help design a comprehensive plan for you. Now, as I mentioned earlier, you don't have to look at buying tomorrow. This could be something you're trying to plan for 2 or 3 years. I met with a couple earlier today that's not going to buy till next year. But what we did today is provide them with a roadmap and some goals and objectives for home ownership, and we can certainly do that for you as well. I want to just touch on just a resource that's available to you via mobile. You can start your application process via mobile. You can also follow the progress of your loan, even use our calculator functions, all via the AP mobile app. Last thing I'll leave you with is just, again, spotlighting our Long Beach State Alumni Partnership and the discount benefits. So we actually discount our origination cost by $750. And we really provide priority service for our alumni partnerships and get you access, obviously, to first-time buyer programs and just give you the resources you need on this path towards homeownership. Now, if you've enjoyed tonight's class, and I hope you have, if you have friends or family or coworkers that might enjoy this content as well, and you'd like to have them get connected with us, we teach over 50 classes like this all online they can check out. Of course, we're going to record tonight's class, so you'll be able to see that up tomorrow, but we'd encourage you to share some of the details of these classes with friends, family, and some of those coworkers. Here's my contact information. If you want to get connected with me, feel free to reach out to me. And as we mentioned, we're going to have this class up on our YouTube channel, but on our other social networks, we'd encourage you to check out what we share with our communities, because we want to make sure that we provide really great value-added information to our communities. And so you can check us out at J Maida Mortgage on our Instagram and Facebook channels. All right. With that said, we come to the end of class. I'm 2 minutes over time, but I want to carve out some time for questions. I did get one question in the chat, which was, are rent-to-own programs worth it? So it just depends. When we think about rent to own, we're talking about lease option products where you're ultimately negotiating a pre-selected future purchase price with the seller. So I'm renting today and I'm going to purchase the home 2 years from now for $500,000. Sometimes those agreements will include a portion of your rents going towards the future value of the home. It really just depends. I think this market can change at times. So, we got to be careful that, you don't want to purchase a home at a future value that might be a lesser value by the time you're ready to purchase. So we got to be kind of cautious with that. All right. Thanks for that question. Any other questions in the chat that I can answer for you? Okay. See somebody, maybe some typing away there. Okay, cool. All right, good deal. All right, well, it was a pleasure bringing this content to you. Actually, hold on, before I got one more question came in. Do you think, this is always the bigger question I always get, do you think it's a good time to buy now with what's been happening with the economy? Actually, we got a video going on our socials tomorrow. I just cut it today, which was talking about uncertainty can bring opportunity. And I think there is some opportunity in today's market. When there's uncertainty, it will tend to move some consumers to the sidelines, but other consumers may say, hey, there's an opportunity here. From an interest rate perspective, we had the little blip up and down, but we're kind of really where we've always been for 2025. I think with more inventory coming online, I think that does present an opportunity for those that feel like it's the right time for them. As we look at the cycles of real estate, generally real estate will go up. And I think those that have had great buying opportunities have bought maybe in the more challenging times. And so I think, I would encourage you for the person to answer that question. I think it's now, if you're considering the market, I think now is a great time to get connected with us for a consultation. So if you think that there's an opportunity for you to enter the housing market, at least you know what your options look like. And it might not be the right time for you. It may. And so, but at least you know kind of what directionally you can do. All right. And thank you for the great feedback in the chat. I appreciate that. That's very nice of you. Okay, I think we did it. So I appreciate everyone's time this evening. We'll look forward to getting that presentation back out to you tomorrow, along with the recorded version. And I look forward to hopefully seeing each of you for one of your upcoming consultations. Have a good night. Bye-bye.